Hello, everybody. In this lecture series on behavioral finance, we will discuss one of the most important and classic case studies in behavioral finance, the dot-com bubble. The dot-com bubble refers to the rapid rise and fall of technology stocks that happened in the late 1990s and early 2000s. That was the time when there was a boom in technology. A lot of tech giants came into play. They started becoming market legends in the likes of Amazon, Google, Facebook, and whatnot. Any big legend in technology, any tech giant that we consider, did have their origin in the 1990s and early 2000s. And because there was a boom in technology, the world was able to see a rapid rise in technology stocks, followed by a rapid fall as well. So this is called, or this phenomenon was termed the dot-com bubble. In this particular case study, we will explore how behavioral finance concepts explain the extreme market behaviors observed during this period. So the major objective of this case study is to understand the role of psychological factors in the market's behavior and decision making. So the dot-com bubble, as we discussed before, happened in the late 1990s to early 2000s. So there was a dramatic increase in the stock prices of internet-based and technology companies in the likes of Amazon, Google, Facebook, Orkut, and everything had a very big rise. And this was followed by a subsequent market crash that again led to significant financial losses for innumerable people. So the key events that were observed during the dot-com bubble are there was a surge in technology-related initial public offerings. There was a widespread media hype that was created, and the public were more than excited about the potential of internet. This made them invest in a lot of tech giants that predominantly monetized internet's capacities. The Nasdaq index, heavily weighted with tech stocks, it saw an unprecedented growth followed by a severe downturn. So the dot-com bubble can be divided into a lot of phases. The first phase is the growth phase. So this was the time where there was a boom in technology. There was an explosion in the number of tech startups and IPOs. However, most of these startups and IPOs did not work on proven business model. So people, they projected that the future of these tech giants would be highly positive. The investors were highly optimistic of how this market is going to grow in the future, and they started making significant investments. So as the number of stocks raised, as the number of investors plunging into this market raised, there was a drastic increase in stock prices. The enthusiasm of investors directly impacted on the stock prices to increase. However, there was not sufficient financial evidence. There was not sufficient research fundamental evidence behind these surging. For example, Amazon and eBay experienced enormous stock price increases based on future potential rather than on current earnings. So the investors did not focus on what the company is holding in the present, rather, they focused on how the company is going to grow in the future. The second phase is the bubble phase. Here, the phenomenon of exuberance was observed. People were highly optimistic about how internet and technology are going to become transformative. They believed that these tech companies would revolutionize the business and they would be that class of companies who would create huge returns. Also, media had highly positive and sensational influence, which fueled excitement in public, and they made a lot of speculative investments. There were behavioral biases that were observed during this period in the likes of herd behavior, because many started investing in technology stocks. People started again following like a goat. As my friend invests, I would go invest, and the behavior continued. Also, there was an overconfidence because people did not take the risk that is associated with these investments seriously. They underestimated the risk and they overvalued these tech stocks just because they predicted it would have a boom. The third phase is the burst phase. So the bubble grew, it became a very big bubble, and it is this time that it burst out. Here, people started realizing that many tech companies were overvalued and they lacked viable business models. There was there was a very rapid decline in stock prices because investors lost their confidence. There was almost 80% drop in the Nasdaq index from what was at its peak once. A lot of tech companies became bankrupt and they saw their stock prices plummet. The aftermath happened to be incredible financial losses for investors, and people started reassessing technology sector valuation seriously. They started, instead of speculating, they started analyzing what really is happening inside the technology market. So, this particular case study draws attention on a lot of behavioral concepts. The first being overconfidence bias. Investors believed that they had superior knowledge about the tech stock's potential, so they took a lot of risks. Second, this herd behavior. Driven by the action of others, people started investing, thereby creating a speculative bubble. There was excessive optimism. There was an overestimation on future returns. People never thought anything negative. All that came to their mind when they thought about these tech stocks was it is going to grow exponentially. So there was excessive optimism, and there was confirmation bias. People started looking out for information that would satiate their need rather than looking out for information that is evidential. So they disregarded any kind of negative indicator that came by their way. There are a lot of lessons that we could learn from this particular case study as well. Market dynamics, it's utmost it's of utmost importance that we understand the psychological factors that are getting influenced in market behavior. How bubbles form and how bubbles burst is one lesson the entire world learned out of this dot-com bubble. Also, the importance of being diligent and critically analyzing was emphasized more than to focus on herd mentality. People were educated not to follow herd behavior after the dot-com bubble. They started developing strategies to mitigate the impact of behavioral bias. Behavioral finance as a field of study itself came into being after this dot-com bubble. People started understanding how important psychology is in making investment decisions. Also, there were a lot of market regulations coming by in order to prevent any future bubbles and protect investors. So, in conclusion, the dot-com bubble serves as a significant case study in behavioral finance, illustrating the impact of psychological factors on market behavior. Understanding these behavioral insights helps in better market analysis and decision making. Also, this particular crisis demanded for continuous research into behavioral finance and its implications to improve financial decision making. Hope this video was helpful. I'll come back with another interesting video. Thank you. Hello, everybody. In this lecture series on behavioral finance, we will discuss one of the most important and classic case studies in behavioral finance, the dot-com bubble.